Coming. Thanks, Kerry, for organising it. Thank you, Hedley, for having this slightly crazy idea. I just will quickly introduce Hedley. I think Hedley is an investment professional, but the only reason that you should trust him as an investment professional with the money that you give him to invest in mining companies is because if you scratch below the surface of the investment professional, you will find a geologist. And I think we had two gentlemen here in the previous panel who've been very exceptional lenders to industry and investors in industry, also geologists. I think at the end of the day, you know, when you're going to invest in mining, understanding the geology is probably more important than anything. So that's a very important thing. The only other thing I'm going to say very quickly about Hedley is, makes me feel very old standing on the stage here with him, because when I first started in the business, his dad was a bit of a legend. I also invested in Catalyst, which has done quite well, and one of my first clients was Robert de Crepney, and now that's a company run by his son. So when you've been around long enough that, you know, the people that you're dealing with are the sons of the people that you used to deal with, the secret is you started when you were 10, just in case you're wondering. So anyway, Hedley.
Thank you, Sean. I actually grew a beard so that I could look older and get into the same nightclubs that you get into, mate. So I'm pleased that I've caught up. Well, it's a pleasure to be sharing the stage with you, because when Kerry said, oh, Sean's doing a talk on gold and can you do something and maybe you guys could talk to each other to make sure you don't cross over too much, I blurted out, well, maybe we do a talk together and it'd be really interesting because we can kind of riff off each other. And then after that, I was like, how the hell do you plan for half an hour of riffing off each other? So let me introduce Sean to you though, folks. He describes himself as neither a gold bull nor a gold bear. I'm not giving too much away about his generational advantage over me by saying that he's been in the gold market for circa 40 years. So he's seen roughly half and half, 20 years of gold bull market and 20 years of gold bear market. I think what he describes himself as is a gold beast. One of the nicest things that someone I think has ever written about him was when he was leaving Rothschilds in Perth in the early noughties to move back to Sydney. One of the younger members of the team, and, you know, reflecting on the sentiment at the time, said something like, it's a shame to be losing one of the last gold bulls in captivity. So, you know, Sean will come across as being a person who is very enthusiastic, and I think that's time dependent. But you've also got to understand that he can talk encyclopedically about some things. And I learnt a long time ago that a gentleman should know something about everything and everything about something. And I think the latter for Sean is on the gold page. And it's amazing how conversant he can be. The other thing that I do appreciate about Sean, though, before he starts, is if you have a leaky pipe at home, you call a plumber, right? And the plumber comes round and goes, oh, I can see the problem, I know exactly how to fix it, and this is what we're going to do. And that's the kind of advice you get from Sean. You get one answer, one directive, and it works. Whereas if you were to call a lawyer, apologies to all the lawyers, round to your house to say, I've got a problem, the lawyer comes in and goes, goodness gracious me, yes, we do have a problem, and I can see exactly what it is. Now, there's 10 solutions here that won't work, but it's going to cost you an awful lot of money. Sean has actually not bailed me out of, but said to me, mate, this financing's not going to work. The company needs to do this, this and this, and then you can get to the point where this bank will talk to you. So that's the kind of advice that you pay for, but you get exceptionally rarely. And that's why it's a privilege to be sharing the stage with Sean. Reflecting on the theme that we have, oh, look at that. Reflecting on the theme that we have and talking about the Titanic, I was thinking, well, you know, lifeboat type thing. But in this case, I feel like I'm sharing the stage with a lifeguard, because if I lose my way, Sean's going to pull me out of the surf and rescue me and get us back on track. So anyway, Sean.
You're being nice to me because I saw that face just pop up. I saw that.
Well, I might find where the clicker is in a minute and just click that over. But I think to start this off, I need to say it was my idea that we talked together, but it was your idea, the title. Can you tell us why we're on stage at a gold conference and you want to talk about the most famous shipwreck in history?
Yeah, absolutely. I think we're all aware, we probably know the story about the Titanic. We all know where it is right now. It didn't last its first voyage. What I didn't realise is actually just the deficit of lifeboats on the Titanic. I think they put enough on to make it look good. One of the funnels is also fake, by the way. They thought 4 funnels looked better than 3, so they put a 4th funnel on, and only 3 of them actually worked. But the lifeboats were kind of strung around the top, and again, the boat had a nice balance and it looked, but there was only enough lifeboats for the passengers and there wasn't any lifeboats for the crew. That wasn't that they didn't care about the crew, although they probably didn't care about the crew in those days, that it was that the boat was unsinkable, that all they needed the lifeboats for was to actually move them to another boat that would come when they would radio and call for help, because this boat might break down, but it could never sink. I think if we look into the archives, we wouldn't be surprised to find out that the people who designed the Titanic might be the forebears of Ben Bernanke and Janet Yellen. Because if I look around in the world today, that's really what I see. I see the kind of hubris or the arrogance of steaming through an ocean that might have icebergs in it and all the other risks associated with crossing the Atlantic, to actually be that arrogant that you'd reach the height of sophistication, that you'd build a boat that didn't need lifeboats. It kind of smacks of where I think the central banks are in the world today. And unfortunately, we're on the SS global economy and they're on the bridge and they think they have all the answers. And I think we've all seen enough to know, and over the last 15 or 20 years in particular, that they really don't know what's going on. And the central bank governor should never have said in this country that, you know, go out and borrow because the rates won't change for 3 years, because he's actually not in control of it, although they think they are. And I'm sure he's a very nice man, a very nice neighbour, good father, good husband. But he should never have said that, and he's caused a lot of peril for people. But really, the problem is about education. No one should have believed him. No one should have believed. So when we complain and say he said that, we just shouldn't believe. So I think that's one thing. So the thing for me, as I said to Hedley, really, I cannot believe that photograph. But anyway, it's more that I'm smiling, you've got a quizzical look and you're the one behind me. But the person with the mad PowerPoint skills gets to put the faces on. Just remember, of those two, only one survives. Perhaps her name was Rose Gold. Anyway, so I think that, you know, it is interesting, and I think we're all here because we understand gold, and so I made the point, you go outside, a lot of people just think you're slightly crazy. I have that experience all the time with people I know say, well, is it even relevant still, Sean, in this day and age? It's more relevant than ever in my view. But I think the kind of thing is, it's what I've observed, and I've lived and worked in Asia, and I've been here and I've been in the gold market for 40 years, that people kind of are rude about people in Asia that accumulate gold. And they accumulate gold all the time, and they're accumulating a lot of gold in the late 90s, for example, when it was very cheap and all the Western sophisticated central banks were busy selling, and the major gold producers in the world were hedging just stupid amounts to keep mines open that should have been closed. And the only thing that stopped the gold price from not going below 250 was Asia just sat there and accumulated all. And the more sophisticated people in the West go, oh, you know, so they're almost damned by faint praise. People say things like, oh, well, if they had other things to invest in, I'm sure they would. You know, who's having the last laugh right now? If you think about it, like at the absolute low of the gold, central banks were busy selling. Now, Eastern central banks are now buying, or non-Western central banks are now buying. The Western central banks are still nowhere near it, and so really is no one in the West, right? So if the central banks that run our part of the world are not dealing with this, we need to look after ourselves. And that's the picture, that's the image that I wanted for people to take away. It really is that gold is, you know, gold is that, in my view, gold and silver to an extent, that's your lifeboat. You've got to have something that's going to help you go through. I don't necessarily share all the views of Man with a Hat, but he's done a lot more research on those things than I do. I take such a dramatic view about the future, but I do think absolutely it makes perfect sense, and I'll show you how well it's worked for people in Japan a bit later, but this idea of having some amount of gold in your portfolio. Yep. Yeah, so I think that's really the big thing, and we'll get back and sort of stretch and draw out this, continue to kind of kill this analogy whenever we can.
So I was going to ask you what you're really going to talk about, but I think your point is well made there. Give us 3 dot points before we get to your charts then, Sean, about, you know, what are the points you're going to make, and then I'll tell you the points I'm going to make, and we might get into some charts.
Yeah. Well, I think the Swiss bankers portfolio, when I first started in the industry, people used to say, you know, 5 or 10% of your net worth in gold, and hope like it's never worth anything, because if it is, the rest of what you own's gone to hell in a handbasket. And again, there's places in the world right now where that makes sense. So I think it's really coming back and looking at that. Well, what is the right percentage? And we'll talk a little bit later when we talk about shares, because I don't necessarily even know that gold shares are part of your lifeboat. I mean, I think it's more like physical bullion, and gold can be part of everything. But when we get a bit more into the discussion, we can do that. So that was one of them. I think just in terms of sort of equities and icebergs, the interesting thing just to talk about, and we'll see a picture of this a bit later, in 2007, if you were feeling a bit uncomfortable about the world and you were in Australia and you decided that you'd heard about that Swiss bankers portfolio and everything was going really well, why not go and buy 10% of gold? If you'd done that in 2007, that gold in your portfolio today would form 33% of your portfolio. So, clearly it's outperformed by a factor of 6 on the rest of the equities. So, but the important thing is, and I think there was a comment someone made that asked the question before about interest and stuff, and I think it is really important that you're right if you're taking the cash analogy, but like the worst thing in the world, the only thing worse than holding dollars, in one sense, is to hold dollars under your bed, because at least if they are earning interest, you're getting some power economy. But you've got to remember that interest or dividends, compounding of interest, is the 8th wonder of the world. So when you're in this context of gold, it is important, I think, that you've got an element of it in your portfolio, but you've got to have things that are interest-bearing, and obviously well-run gold mining companies are one of the people in that category. But you've got to be careful. I wouldn't be all in gold. I mean, it's your lifeboat, not your boat. Your boat that's going to take you to the other side, the actual investment portfolio that's going to get you through and pass assets on to your grandchildren or whatever, has to be a combination of a whole range of things, but ideally lots of them are income generating, so you can keep reinvesting and get the power of compound. But I do agree with the statements made earlier that there's inherent interest in gold in terms of it has had that capability. So I think those... and the last one I have to say, the benefit of gold over just about any other investment, no proxy forms. Like, seriously, like the amount of mail I get every day from companies, gold just doesn't ask any questions of you. It doesn't do anything. So I think that's one thing that you really want to remember. And the other thing is that in that period since 2007 that I mentioned, Australian equities closed down 5 years. There were 5 down years since 2007. There are only 2 down years for gold. And the one big down year in that period, when equities were actually down 50%, gold was up 33%. That's the thing. That's the lifeboat. You could actually weather the storm because you had the lifeboat, and I think that's a really good example. Yeah,
terrific. So, look, what I'm going to talk about, Sean, is probably the flip side of that.
Yep.
And you've talked about gold being the lifeboat, and I completely agree with that. There's this other way to play it, which is, do you invest in the gold equities? So I thought what I would unpack is this concept of leverage, and it came up last night. The concept is if gold goes up, then the equities can squeeze that and potentially perform better. So I want to look at that.
Yep.
The conclusions might be a bit surprising, but I've got some examples to go through as well. And in the spirit of lifeboats, I suppose I think of gold equities as being something that can provide the performance of wiping out all of what you had in it, in which case it's not a very good lifeboat at all. It's more like expecting Elon Musk to turn up in a rocket and pick you up when he's very unlikely to do that from the sinking Titanic. The flip side is if you'd put money into Northern Star at some stage along that journey, if you'd bought it at 3 cents, well, you're retiring now. You've got 0 other concerns in the world. But if you'd bought it at $15 just before Bill Beament retired, then you're probably underwater. So timing clearly is a big thing with that, and I think timing is far more important for the gold equities. So it's that concept of leverage or...
So whereas gold might be a generational hold, and we can talk about how we move in and out of it, gold equities, you don't put them in the set and forget basket.
I don't think so, no. I mean, gold you could conceptually think is a set and forget, and you buy it and keep it, although you talk about 5% being your lifeboat. I don't know how you get 5% into a lifeboat. But in the concept of the financial markets, where you're never going to wipe out everything if you're across the market, then that's the thing which enables you to get started again, which is the concept.
I'm not trying to only get 5% of me into the lifeboat, but I do know what 5% I put in if I could only put 5% in. But I am saying you only spend 5% of your budget or 10% of your budget on your lifeboat. At the end of the day, that's what it is. It's not your boat. It's not your investment vehicle to carry you across. It's that thing that is there if something is going awry with the big boat.
Well, I'll tell you what. I think we've got some slides.
Yep.
Let's look at yours first. Now, I've got people call this a clicker. When you switch between slides, it's actually clacking. So this is a clacker.
A clacker.
I'm going to clack for you.
Okay, thank you.
Go, mate. Over to your first slide.
So I put this slide up before, but basically, if it's got a green background, it means it has a positive weekly trend on the scoring system that we use at Noah's Rule. If it has a red background, obviously the weekly score is negative. You can see the scores tend to change and they stay changed for a long period of time. What we're looking at here is there's a green background here. Gold is underperforming equities, all right? So if you spent $1 on gold or you spent $1 on equities, then the dollar on equities is doing better wherever there's a green background. And you can see between 1980, when gold made the high of 850, and to the near 2000 lows, that it went from 1-to-1 to about 44-to-1. And Pierre Lassonde came to Australia sometime in the late 90s and started talking about this ratio and saying, you guys are all crazy, your gold miners are hedgers, you're a gold producing nation, you've given up on gold. I think that the ratio can go back to 1-to-1. Now, I finished school the year that ratio was last in 1-to-1, so I believe it can go to 1-to-1 again in the future. Today it's at 16-to-1. Right, so if you look at it in that perspective, gold was ridiculously cheap in the early 2000s, we know that, but it was ridiculously cheap relative to equities. So if your grandfather had decided to sell his gold and buy equities in 1980, by 20 years later, could have bought 40 times the equity portfolio. 40 times the value equity portfolio with that 1 ounce of gold. So, you know, that's an incredible period there to be out of gold, and, you know, really you want a minimal lifeboat. But again, because you had plain sailing, you can see the period the other side, how quickly that we fell down. And we got down to about 5 in 2011. So 2011, the first time gold went to 1800, we were at 5-to-1. We're now at 16-to-1. The other thing, can I have this thing for a second?
It's called the clacker.
The thing I would just point out, where's the,
big one.
is just 16 is where we are right now. And I think what's really interesting is how rapidly the ratio fell through 16 back in the 70s and how rapidly it fell through 16 here. Now, one of the parts here that the ratio fell very quickly was because the equity market halved, not because gold went up. So equity market halved, and then the gold started going up and gold went up very strongly and equities actually started to recover. And the other point I always like to make in these conferences is all the people who feel that there was some conspiracy in 2013 when the gold price collapsed. It wasn't at all a conspiracy. It was just all the generalist investors who feel they must own some gold in their portfolio, professional investors, when gold is outperforming general equities. Saw a green background by whatever measure they were using, saw it back through the 200-week moving average, and said we don't need to own gold anymore. So that's one of the things that you must understand about the flow of money into gold. Everyone in this room, like, we're all long and waiting for all the rest of the world to wake up to the ideas about gold. I'll leave you to clack. And it's really that you need those outside people to come in, and they need some incentive to come in. And because you can't value gold and because it doesn't pay interest, and that's very important to those people in terms of their overall portfolio performance, the signal that they do need is it must be outperforming, and I've made this point time and time again at conferences, it's outperforming general equities. So at the moment, it's just been kind of, you can see, outperforming US equities, but really it's been matching US equities. Despite all of the fascination, all of the good stuff of those other IT stocks, gold's been holding its own. But if we click through quickly, Hedley, look in Australian dollar terms, and there's that 1987 up near there, as it was nearly 8-to-1 now. It's at 2-to-1. It's got a red background, it's in downtrend. Gold is outperforming the All Ords. It has been really on a trend basis for a couple of decades, but certainly for the last 5 years. And you would want to continue to favour gold over general equities while ever that trend is there. But if we get a strong turnaround like we did in the early 80s, that might be the time where you want to rebalance. But at the moment, certainly from purely gold versus equities, there is absolutely a powerful logic to be holding gold in your portfolio. And it's been that fantastic lifeboat, as I say. I mean, it has outperformed 6-to-1 general equities over that period. Now, if we go forward, this is the market I think that is really fascinating to look at, because Japan, Bern Bernanke and all the American went over there and experimented with their economy. Like every kind of funky bit of monetary stuff that's been done in the world has been in Japan. Everyone says, where may be the next Japan? Well, just go back to 1989, we'll remember, is when the Japanese equity market, so fine, equity markets are going up, green backgrounds, all fantastic. And then the bubble burst in Japan. They've tried every bit of funky economics since. And where is that ratio today? Now, you might remember the Nikkei in the last couple of weeks just got back in yen terms to the same price it traded at in Japan. And yet here we are, gold has outperformed from 0.62 of an ounce to you only need about 0.1 of an ounce. So again, outperformed enormously. Japanese investors have, the only way you have held your wealth in Japan, the only thing that has kept you on the right side of things in Japan, the right side of financial history, really has been, in the long, has been to be long gold. And the Japanese have a real affinity for it. And just quickly, the last one, which is interesting to look at, is this is a much shorter time frame, just only dated back to 95, but the Shanghai Composite versus the local currency. And what's interesting here is Chinese equities are in the gold bargain basement. The last 2 times that Chinese equities got this low relative to gold, Chinese investors sold gold and bought equities and saw fantastic rallies. So there'll certainly be, that'll be in their minds, we're getting to the point where equities are really cheap, got to move your money around in a bucket, but for the moment it's catching a falling knife. So we're watching that one very closely. If you saw that trend change, that could really be quite significant for gold because of just how big the market is and how much they've got involved. But for the moment, again, red background. So all 4 of those markets, gold is outperforming general equities. It makes perfect sense for gold to be part of that portfolio.
You've got one left.
Oh, and this is just an interesting, let's come back to that at the end, can we?
Sure.
I want to make sure you get some time here.
Well, yeah, it's my turn now, thank you. So I'm going to take a slightly different view from where gold is going, and I'm just going to start with a gold chart because I want to talk about leverage. If you're a gold miner, then what does the revenue picture look like for you over time? And this chart goes back to 1987. The reason I chose that is because when I overlay this with an equity series of a gold miners index, it only goes back to 1987. So I chose that date. 1987 to present, if you'd been holding gold, it's a 5.3 times return. So your money's gone up quite considerably. And I guess there's periods within that which look phenomenal. If you're depending on that to underpin your revenue and how much your revenue goes up per unit of output, you know, some of those, Christmas has come many, many times in that period, and sometimes for long periods of time. So for gold miners, you would expect that with that leverage on top of that price driver, they should have performed exceptionally well. Now, this is only one gold index, so you can overlay any one you want, but this one goes back the longest, the Philadelphia Gold and Silver Exchange. Gold equities in that same period of time are up 25%. Now, clearly, you pick a starting point and you'll get a different percentage number, particularly if you're going to say, well, no, I'd like to pick the bottom of the market and the top of the market. So you could get eye-watering performance off of the equities if you pick your timing right and you've got the gold filling your sails and going forward. Just to compare those 2 lines then, what we do is we say, well, let's divide the equity price by the gold price on the day, and then we get a time series of ounces per share, if you like, for the whole gold industry, which is represented by the index. Now, if your share price is going up in gold terms, as in you are outperforming gold, then that line goes from bottom left to top right. And if you cast your eye across that, periods where the equities have on wholesale outperformed gold have been quite short and they're quite rare, particularly with the extended periods of those bull markets. So this is what I wanted to unpack, because when you look at gold equities outperforming, it's not just a case of gold going up. It's a case of timing, and it's a case of what equities you're in. Some are going to be far better than others, and like we said, I mean, Northern Star over the time of one gold bull market has gone from circa 3 cents to $15, and paid dividends, which is a phenomenal return. But I think that's an outlier on one side. At the same time, you might very well have flipped that around and lost all your money. So 3 examples that I wanted to put up just to talk through what success looks like for a gold equity in a gold bull market. So this is back into Australian dollars. That's the Australian dollar gold price from January 2016 to August 24. So it's up to now. And in that time, the $8 gold price has gone up 2.6 times, which we sit there and go, oh, that's a wonderful performance. You think of that as a revenue line for anyone. If you made ice creams and were selling ice creams, and in 2016 you were selling them for $1 a piece and now you're selling them for $2.60, you are absolutely laughing, because that kind of revenue inflation is absolutely unheard of in most parts of the market. I mean, happens in commodity markets, typically not in industrial ones. So I'm going to overlay three share prices priced in ounces per share rather than dollars per share, just to show, and I've messed with the axes, right? This is just for display purposes. I want to show you what success looks like. So this is a rare case. This is a company called Perseus. They make gold in Africa. They've mined several, I think you would call them fairly middling little deposits, but over many, many years, they've managed to make money out of gold. And in this case, if you're in 2016, in fact, if you're in 2018, and many times in that period, Perseus has consistently outperformed the index. And this is a company that just gets on with what they do. The reason I've put this one up there is because it's extremely rare. There are 24 companies in the Australian ASX Gold Index. This is the only one which has got this performance in terms of consistency. And it doesn't perform every single year. So it hasn't outperformed gold every year. It's outperformed gold in most of the years in that time frame. Another great one which you've got to mention if you're talking about gold is Bellevue. Now, this is a company which purchased a gold project, then invested in drilling it, pulled out some high-grade results, and has now built a gold project and is starting to produce gold. And that has had wonderful leverage to the gold price. But if you go back and look at the history of this company, and particularly if you look at their price priced in ounces, there's been incredible volatility there. So when you purchased, if the assumption is you bought it on the 1st of January 2016, well, great, that was fortuitous. But there's a couple of points in time that if you'd purchased that, you would not have done so well, and certainly not as consistently as something like a Perseus. So a success, yes, but timing is highly dependent. And then just because you have to, I've put on the 3 biggest gold producers listed on ASX, and I've included Newcrest, even though it doesn't exist anymore. I've just extrapolated the price of Newcrest to the present using the Newmont performance, just to finish off the series. So the 3 biggest producers, if you'd purchased them all at the start of that gold bull market, then you'd be doing well. You'd be outperforming gold over that time period. But in the last 3 years, since 2019 or even 20 or 21, those companies have all underperformed gold. So this concept of when you get them is important. And I think when you delve down into all of those, what you quickly find is that there are reasons why these companies outperform gold. And that reason is very rarely the gold price that they have outperformed. It's far more to do with their behaviour and their operating performance. Now, I work in the land of speculative stocks and explorers and developers, so I just quickly wanted to show what the perspective looks like for them. I used 250 odd companies to figure out how they would have performed against an index. So we've got the Australian Gold Index, we've got the Australian dollar gold price since 2016, and if I overlay my gold explorers, they're all considerably off. Now that's in a market where the gold price has gone up, and people say, well, why? Firstly, because they're the stocks that don't make the index, so the selectivity of an index means that all the successful companies stay in and the ones that aren't fall out. The median of these explorers is going to be poor for that reason, but the thing you've also got to remember is that for any one product, whether it's an equity or a commodity or an ice cream, the price reflects the number of buyers versus the number of sellers. And at the moment, there are far, far more sellers for the explorers, no matter what they're looking for, than there are buyers. So I think if you want to use gold equities as your lifeboat, first of all, you've got to be very careful about jumping into a producer, and you've got to be extraordinarily careful about jumping into a lifeboat which is an explorer. But having said that, if you find yourself in a lifeboat which is an explorer and it's rescuing you, there's a good chance that it's going to be rocket powered and it'll get you to the shore. The lifeboat concept breaks down. It can be life-changing. So, probably similar rules apply in terms of how much you would put in. But so that's my perspective, Sean. But we've got a couple of minutes left. Should we ask each other questions?
Yeah, or can I just make a very quick observation? I think if you have your normal equities over here, or whatever property, whatever your portfolio that you want to have, and you have the physical gold over here, then I think gold shares reside somewhere in between. And I think in the very short time frame, I think when you look at what Hedley's saying, if you start with gold and you say, I'm not giving up this gold unless I can really see value, you have to ask the question, what would I buy with that gold? So if we saw that ratio where you could buy twice as many shares in the ASX a year from now as you could today, so gold doubled relative to the thing, you go, oh, maybe I'll let some gold go. But you don't let it go just because the price is high, you let it because something else you could buy. So I think in that middle ground, I question whether gold equities are part of your equity portfolio or whether they're part of your gold portfolio. You're selling gold to buy gold shares, or you're selling, you're selling banks or something to buy the gold equities. But in both cases, whenever you do, if you come to gold equities, it has to be outperforming the equities that you've got. Unless gold equities are doing better than the equities, why would you sell the equities to buy gold equities? And if those equities aren't doing better than gold, then move all the way across and invest in gold. Does that make sense?
I agree. I have one question for you for us to finish on, and it has to do with gold. But gold is neither a commodity nor a currency. It kind of fulfills both roles from time to time.
It's money.
It's money. So now, but a lot of people think of this as something which you mine out of the ground, which is a commodity in that sense. Copper is also a commodity. When copper goes up and it hits a price level, this pain comes into it. So taking gold example there, when gold starts to go up, I don't think there's a single buyer in the world that feels pain there. They go, if I need to own the gold, I'm going to pay the price because I want to own it. It's not because of the price. What does that mean for the upside in gold in a market where gold has a bit of a rocket under it?
Can you click back to that
chart?
So I think the reality is if gold is just the alternative asset, if gold is nobody else's liability, if it's the place that you go, like, the storm is coming, you want a bigger lifeboat, whatever it is, what this chart in terms of the colours is, where it's green is the dollar is in downtrend and gold is outperforming general equities. So gold is doing better than general equities and gold is falling. And you can clearly see in that period from 2000 to 2008, people took gold from $250 to $1,700. They didn't do that because it had some fundamental value. They just did it because it was outperforming those other things. So you keep buying it till it stops outperforming those other things, as it did in 2012, and then it collapsed. And when you see in the red is when it's not outperforming general equities and the US dollar is rising. In that time frame, you need the smallest lifeboat you think you can get away with. You don't need to be over-invested in gold. But to your point, Hedley, in those rallies in the 70s, once it goes, it's just going, and as long as it's seen to be more valuable or safer than everything else, that's it. And the thing you've got to remember is you don't fall so far in love with it, at some point you go, why did I buy it? I bought it for protection. What you don't do is you don't go down with the ship because you don't want to use your lifeboat.
I think Pete's going to call in a fire drill to get us off the stage, but the parting comment then is, wonderful environment for gold, you're all here, and there's a bunch of companies you can talk to. Questions you need to be asking them are, what are the things going to set you aside and enable you to hitch yourself to that gold price and make that catalyst a positive one for you? That's my final
Fantastic. Thank you, Hedley. Yeah. Thanks a lot.
Mate. Thank you for
Ladies and gentlemen, Hedley Widdup and Sean Russo.
Thank you.
And that